Greetings and salutations. Today we're going to look at the company Medifast, headquartered in the United States and traded on the New York Stock Exchange under the ticker MED. Please stay tuned for the important disclosure information at the conclusion of this video. Medifast is an American company that offers services and products to help to lose weight. Although the company was founded in 1981, the current business model was established in 2002. In 2017, it rebranded its service under the current name Optavia. In this business model, the customers work directly with the company representatives called independent coaches. The revenue is generated by customers subscribing to a proposed specially balanced nutrition meal plan. Independent coaches receive a commission from sales and support customers on their journey. As the company claims, 90% of the coaches were customers before. In 2019, the company was trying to capture new markets in the Asia-Pacific region. These plans were abandoned in 2023. The company was also proposing to establish a presence in the Latin American region. However, it appears to be more aspirational rather than factual, with the United States completely dominating the revenues. In 2023, the company introduced a new product, muscle gain supplements. And in 2023 to 2024 began this pivot. Medifast announced a strategic collaboration with LifeMD, a company that offers GLP-1 medication prescriptions. In this partnership, both companies refer their customers to each other. Medifast offered a new product meal subscription to support customers on GLP-1 medication. In addition, the marketing strategy was updated as well. Instead of heavily relying on TV ads and word of mouth, the company started individually targeted digital ads on social media platforms. Now let's try to understand some details about Medifast weight loss offering. Please note, this is not medical advice, and this channel insists on consulting with your healthcare provider about anything discussed in this video. The weight loss market is significant in the United States, with about 70% of the population overweight and 40% obese, according to some estimates. As the company claims, for $455 a month, Medifast offers a subscription service of nutritiously balanced meals, along with coaching and community support to form healthy habits for sustainable weight loss. Now let's also try to understand some details about GLP-1 medications and Medifast's new subscription service. According to some sources, wildly popular GLP-1 medications make a revolution in the weight loss industry. While continuously taking GLP-1 medications reduce appetite, thus preventing the excessive consumption of calories, which results in weight loss. The medication works for as long as it is continuously taken. The moment the medication is discontinued, the appetite might return. Moreover, the reduction in appetite might result in an unbalanced diet, leading to muscle loss and microelements deficiency, among other challenges. The $386 a month Medifast subscription for GLP-1 users aims to cover this gap and provide nutritiously balanced meals, along with coaching and community support to form healthy habits for sustainable weight loss. The company adopted its current business model in 2002. From 2002 to 2010, the company saw a rapid growth of revenue at 40% compound annual growth rate. Between the years 2011 and 2016, the company entered a period of no growth. And with rebranding in 2017 and mass popularity on TV, an additional several years of 41% growth per year was followed. In 2022, the company was challenged with the new GLP-1 medications recently offered on the weight loss market, with a rapid deterioration of sales. Please note that the company sailed through the 2008 Great Financial Crisis and the 2020 pandemic with flying colors. The company does not provide an exact number of customers, and there are a variety of different meal plans offered. Nonetheless, we can estimate the equivalent of full-year subscribers for 5-in-1 meal plan based on the current price and assumed inflationary price changes. In the mid-2010s, the number of full-year customers hovered around 60 to 77,000, accelerated to almost 300,000 in 2021, showing good scaling of the business, and currently reduced to about 67,000 based on tougher economic conditions due to higher interest rates, along with GLP-1 competition. The number of coaches was reported by the company since 2007, and we can estimate it beforehand. Given the estimation of the weight loss supplement market of around $8 billion in 2022 and a growth rate of 6% per year, we can also calculate the market share of Medifast. In the first 5 full years, the market share rapidly grew from 1 to 2.7%, later stabilized around 5 to 7.4%, and showed a remarkable growth to 20% in 2022. Now let's look at the expenses. Cost of goods sold was about 24 to 29% of revenue. Also, the company owns its production facility, which can cover about 50,000 full-year customers. Sales and administrative costs used to account for between 58 to 60% of revenue. However, this number jumped to 69% recently. Advertisement was reduced from $15 million in 2014 to $3 million in 2023, and jumped back up to $16 million again in 2025. Research and development was gradually increased from $1 million in 2014 to $5 million in 2025. Taxes, including taxes for stock repurchases, accounted for about 3.5% of revenue, or 30% of earnings. Capital expenditures are about $6 million per year. Free investable cash flow margin dropped from 10% to 1% of revenue. How did the company allocate its capital? Historically, 40% of free investable cash flow was spent on buybacks. And with dividends of 46%, the total share of returned free investable cash flow is at almost 90%. The remaining free investable cash flow was spent on retained cash, investments, and other. The CEO, 60 years of age, joined the company in 2015, and the CEO since 2016, that the remaining executive management is tenured with more than 5 years of service on average. Together, individual insiders own just 2% of the company, with the remaining 98% owned by institutions. The company has no long-term debt. The liquidation value per share is estimated at $15.65. Now let's estimate the intrinsic value of the company. The future revenue is highly uncertain due to economic slowdown as a result of elevated interest rates, competition to the traditional weight loss subscription from GLP-1 medications, and the new service offered to support individuals on GLP-1. Therefore, we will evaluate 4 major scenarios. In the first, the company invests $16 million per year in advertisement indefinitely, but wins no GLP-1 customers whatsoever. Also, the customers from the traditional weight loss stream are reduced to 59,000 full-year subscribers. In the second, the company experiences the same conditions as in Scenario 1, but starting 2027, it discontinues the $16 million per year advertisement and reestablishes the dividend, equal to the free investable cash flow. In the third scenario, the company experiences the same conditions as in Scenario 1, but wins the GLP-1 supplements market share, equal to the market share of traditional weight loss services during the 2003 to 2007 years. And finally, in Scenario 4, we check the sensitivity of the GLP-1 revenue stream by dividing its market share by half. For the failed GLP-1 service and endless advertisement scenario, we make the following assumptions. Revenue in 2026 is projected at $350 million. 2026 revenue is based on the trends in the number of independent coaches. The revenue grows at 6% after, in line with the weight loss supplements market growth. Cost of goods sold, we estimate at 28% of revenue, sales and administrative at 67% of revenue. Taxes at 28% of operating cash flow. Advertisement at $16 million per year, research and development at $6 million per year, and capital expenditures at $6 million per year. Other costs include expenses to keep account payable at 8% and inventory at 6% of revenue. With these assumptions, the model suggests a positive free cash flow. This would imply an intrinsic value somewhat above the liquidation value. However, this also means that the liquidation value is to be retained and, especially given the absence of debt, the survivability of the company. In the second scenario, we assume that the management stops the futile $16 million per year advertisement and redirects funds into distributing dividends. At the discount rate of 7.5%, using the dividend discount model, we estimate the intrinsic value to be $34.50 at a conservative 4% revenue growth rate, and $79.10 at a 6% growth rate, which is the rate of weight loss supplements market growth. In the third scenario, we expect success in winning the GLP-1 supplements market share, similar to the success in the weight loss supplement market. That is 1% in the first full year, increasing to 2.7% share by year 5. The free cash flow and cash in excess of 10% of revenue are returned as dividends. With these assumptions, a discount rate of 7.5%, expected dividends, and price to free cash flow ratios of 12, 17, and 27, we can estimate the intrinsic value at $50.7, $68.8, and $105.2 respectively. In the fourth and last scenario, we look at the intrinsic value if Medifast achieves winning only half of the market for GLP-1 in scenario 3. That is 0.5% share in year 1 and 1.35% share in year 5. In this case, we can estimate the intrinsic value at $31.7, $42.2, $63.3 respectively. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.